Welcome everyone to the 13th session at the end of the 13th hour on this 13th day, which marks the very last of Frontier's conference sessions for 2021. My name is Desmond Tam, and I'm a consultant within Frontier's practice area that services and supports liability-driven investors. I'll be the host of this session, and I'm joined by Eli Sakeley, who is the head of liability-driven investing at Frontier, as well as Joaquin Mack, who is a qualified actuary and the executive manager for investment strategy and portfolio management at Suncorp Group. Before I go on to some housekeeping matters, first, Frontier would like to acknowledge that we are hosting this webinar from the lands of the Wurundjeri people of the Kulin Nation. We also acknowledge the traditional custodians of the various lands on which all who view this webinar are located, along with all Aboriginal and Torres Strait Islander people viewing the webinar. We pay respect to elders past, present, and emerging, and celebrate the diversity of Aboriginal peoples and their ongoing cultures and connections to the lands and waters of this country. Secondly, for the members of the audience, please feel free to lodge any questions throughout the session via the Q&A feature down below at the bottom of your screen. Please don't feel shy to hold on to your questions until the end of the session, as we'll attempt to answer them along the way. So for this session, the objective will be to compare LAGIC or APRA-regulated insurers versus government insurers. Structurally, these two types of entities are very different. And in this session's very loose structure, we'll be aiming to bridge that gap by one, discussing the differences in portfolio construction owing to separate regulatory regimes. Two, reflect on the COVID-19 experience, which I'm sure is everyone's favorite topic. And three, turning to the future, identifying the portfolio risks and challenges faced in a post-COVID and low interest rate environment. Something to note is that by virtue of the insurance that government insurers write, as well as our guest presenter, we'll be making reference to general insurance lines. However, the considerations and discussion points are absolutely still relevant to life insurers and private health insurers. It should be noted that it is intended that private health insurers be brought under the LAGIC framework from 2023, which internally, endearingly, we've called the FLAGIC framework. Now, perhaps we'll go first by alphabetical order, or all the same, the one who has clearly had the most recent haircut, Eli. Why don't you tell me in 2 minutes or less a little bit about what you do at Frontier?
Thanks, Desmond, and good afternoon, everyone. So my key role at Frontier is to ensure that our advice to APRA-regulated and government insurers, or broadly speaking, liability-driven investors, is best practice. Essentially, we see our role as helping add value in the investment process by better understanding and taking into account the liability profile of each of those LDIs or insurers, and taking advantage of that structure and that risk within their portfolios. And as we'll see today, there are very many different types of government insurers, and that contrasts quite differently to general insurance or health insurers or even life insurers. So what we've been doing over the last 12 months at Frontier is ensuring that we have the appropriate capital market assumptions. It's understanding the liability profile and cash flow profile of those LDIs or insurers, and understanding what are the opportunities in the market that would help those insurers navigate their way in a low return, low yield environment. Thanks, Desmond.
Thanks, Eli. Joaquin.
Well, thanks, Desmond, and thank you, Frontier, for inviting me to speak today at your conference. Very honored to be here. My name is Joaquin Mack. I head the investment strategy team at Suncorp, and my team's key responsibility is really setting the group's investment objective and the broader investment strategy across all the group's assets. So that would involve asset allocation, ALM considerations, and also risk appetite and risk limits in what we refer to as the RAS. Suncorp as a group has a diverse pool of assets. Obviously, the main pool of our money is in general insurance business, but we have also have exposure to life and defined benefit schemes through our New Zealand business. And of course, we have the bank, and through that, we have the wealth management business, which of course has, as we all are aware or know, has been recently sold off to LGIA Super. So there's a lot of transition going on there. My team work very closely with a broader investment team. So we get involved in all aspects of investments management, and that includes manager selection, portfolio construction in that aspect, and all the way down to implementation. Especially with a change in strategy, it's hard for the strategy team to set an SA and just step away from that and say, that's it, my job's done, over to you. No, that doesn't work like that. You still get emails and a tap on your shoulder saying, like, what do you mean by, introducing this asset class? What are you looking for in the managers? And we work very closely together with a whole broad team.
Thanks, Keegan. I might ask, so when it comes to insurers, obviously they have two ways of making money. They can make money by investing their assets into various investments to generate return. They also have the underwriting portfolio where they can price premiums appropriately and get an appropriate return on equity through proper claims management and expense management. So my question to you is that perhaps often investment returns are a secondary objective or an afterthought when it comes to overall profitability. How important are investment returns at Suncorp, and what impact would they have on, say, the pricing of premiums in a very competitive market?
I would disagree with your comment, Desmond, on saying that investment is a secondary consideration. No doubt, insurance, it really depends on the risk appetite, to be honest. Some different insurers may have bigger appetite for investment risk, and some may have less, but the volatility contribution from investments and natural hazards are the two key drivers to year-on-year profit volatility. And I would say investments are probably one of the key things that senior management will look at very closely. If not, I wouldn't say day-to-day, on a day-to-day basis, that would be ridiculous, but definitely on a month-to-month reporting needs.
Yeah, so we do have a chart up on the screen that shows the profitability of insurers over FY21. You can see that, yes, indeed, investment income has been quite a significant contributor to overall net profit. I might flick over to you, Eli. So obviously, when it comes to government insurers, profitability is a key component because of the different operating environment, not only politically and regulatory-wise. Could you sort of give some color as to the importance of investment returns for government insurers?
Yeah, absolutely, Desmond. And just to be clear, when we talk about government insurers, we're going to be referring today to two types of government insurers, that being workers' compensation schemes and CTP, or compulsory third-party schemes. And both of those are typically state-based. The other type of liability-driven investor that we would advise and do advise would be redundancy trust or long service leave schemes, which have a very different structure and profile and a very different purpose. So if I make reference to CTP and workers' comp schemes, for example, we know that there are inflows from premiums coming from businesses or road users. In the case of CTP schemes, those premiums are collated into a pool, and that pool of money is invested in markets through a range of asset classes, which we'll talk about in a few more minutes. Now, those premiums are typically charged, as I said, to businesses and citizens of the state, and therefore it is a sensitive issue. It is potentially a political issue if there is pressure on premiums to rise. As citizens have a vote, citizens assess the ability of the government to manage its finances, and they would obviously prefer that those premiums don't have too much volatility year on year, and they're also quite predictable. The main case there is car registration payments going to the various state CTP schemes. So when we factor that in to account, and then we think about the role of the investment portfolio, it is essentially to back those liabilities, which mainly are very long tail liabilities. So we refer to these organizations as long tail insurers. Typically anywhere from 12 years plus is the liability profile, with some liabilities extending out beyond 50, 60, 70 years, depending on the date of injury to that particular person or people. So what does that mean for SAA and asset allocation? It means that those portfolios are very long term. They are trying to be as sustainable and self-sufficient as possible. No CIO of a scheme wants to be going back to Treasury asking for more money because investments haven't performed as expected or there is a hole in the budget. On the flip side, these schemes can return a profit. They can make extraordinary investment returns, particularly when growth assets are performing well. And then in that environment, governments typically try to put their hand in the till and take out that surplus capital, which does potentially impact the incentives and the alignment of those incentives between investment teams, the scheme's boards, and also Treasury of that particular state. If you think about it at a whole of state and government level, the question the Treasury would ask themselves is, what is the best use of that excess capital? Is it to fund development of new roads, hospitals, schools, or is it to invest in that particular scheme's investment pool? And so that is one big part of the investment process for these schemes. The other one, which is quite interesting to me and one that I'm happy to explore in a bit more detail, are the incentive structures for those teams. So we know that typically these teams are quite small. They attempt to refrain from overly complex investments because of the additional cost of monitoring and due diligence required to invest in complex asset classes or strategies. But also there is no real upside. It's an asymmetric payoff profile. So the risk from our perspective for those teams is to the downside. The idea is those portfolios are there for the long term to back those long tail liabilities, not to shoot the lights out, not to attract new members, not to compete in the performance tables. It's in fact quite the opposite. It's very risk aware, risk averse. And as Joaquin mentioned earlier, very much focused on the risk appetite of that particular board.
So Eli, just as a follow-up question to that, how does that influence the SAAs of their portfolios? We got on a slide here that it seems that they are quite focused on the likes of property, equities, and whatnot. Can you provide a little bit of color as to why this is so, noting again your comments that these entities are very, I suppose, cash flow positive and they are focused on the long term?
Yeah, so historically, a number of these portfolios were very much tilted towards fixed income and particularly inflation-linked bonds. If you think about the long tail nature of the liabilities and also the long duration characteristics of inflation-linked bonds and their ability to move with realized inflation, it does sound like quite a neat hedge. However, over the last few years, we've seen these schemes, and rightly so, diversify their portfolios on the expectation that inflation will be low. Inflation-linked bonds have returned below inflation for these schemes. In other words, the liabilities of these schemes are not only attached to inflation, but also superimposed inflation. So anywhere between 1.5% to 3.5% of superimposed inflation is typical because the payouts or the claims made by those citizens or road users do go towards paying income protection, legal costs, and healthcare costs, which we know that healthcare costs have exceeded the typical basket of inflation goods over the long term. So we've seen these schemes move towards more growthy type portfolios, either at the bare minimum, 50-50 portfolios, anywhere up to 75-25 portfolios in the extreme scenario. And that is all about hedging long-term growth.
Yeah, so then if we look at the APRA-regulated insurers, we can see that it's quite a different case. So let me go over to the next slide, which should show that for the majority of APRA-regulated insurers, there's a huge focus on fixed income. Joaquin, I was wondering if you could provide any color or information on this, and perhaps might be worth referencing the way that traditional insurance portfolios have been managed through this technical reserves and shareholders fund structure.
Sure, Desmond. I mean, there are a lot of similarities and similar points to what Eli raised earlier as well. Excess capital is a consideration, and with the exception that, the team and Suncorp or, the management gets rewarded directly and when the fund has performed and or the business has outperformed and been able to deliver back return on capital to shareholders. On the portfolios, general insurance are really, their line of business are really focused on the short tail. And most of the businesses here have duration of probably not more than 3 years or so on average. It depends really on the profile of their overall insurance book, but generally I would say 2 to 4 years would be the typical sort of duration that we're looking at. So much shorter than the sort of insurers that Eli was talking about. And simply because, that's the cost of capital. To run a business and being APRA regulated, from APRA's perspective, the key is protection for policyholders. The assets in the portfolio or in the book or in the business, essentially it's there to protect, to be able to pay out claims when you need to, and you need to hold excess capital on top of what your liabilities are, to ensure that you have sufficient money or assets to pay out policy claims in times of stress, as we have seen recently. So the cost of capital of growth and riskier assets naturally, is higher, is correlated. The higher risk, the higher cost of capital. So it all comes down to the mix of business that you have, the type of book that you're underwriting, and also, the sort of capital that you're aiming to wear, and the return on capital that you think that you can deliver on that.
Nikki, can I clarify if this is return on effectively equity, or is it capital in the sense of regulatory capital?
So I suppose there are many ways that you could define capital, but mostly for us, and I think it's probably the most pragmatic way to do it, is to look at the risk-based capital, because all general insurers are subjected to minimum capital requirements by APRA. So meeting that, it's key. It's not having that enough capital, you would just be in all sorts of trouble. So meeting that minimum, and then obviously everyone will have a buffer about that. Nobody wants to operate near the minimum. So you have a target capital, and then you have your excess above that. And it's all about efficiency. When you're running a business, especially one that a business that's listed, and if shareholders' requirements, it's really balancing shareholders' requirements and policyholder needs for stability, and also return to shareholders. So, when you have too much excess capital in your balance sheet, naturally shareholders will ask, what are you doing with that? And, if you find that you cannot deliver the sort of return on capital that they are seeking for, they might just go somewhere else with their money.
So it does seem that APRA-regulated insurers are kind of stuck between a rock and a hard place, where effectively you can't have too much capital, but you can't have too little capital. Eli, if I move over to you, is this a similar story that plays out with government insurers?
Yeah, it is actually, Desmond, even though the rules are quite different. For instance, there is no APRA requirement to hold a certain amount of capital. And in fact, schemes can be underfunded, as it were. They can dip below 100%, as long as there is a plan in place, and as long as the board and all stakeholders are fully aware of the actions that are required to get back within that target range. And based on what I've seen and the investors I've spoken to, that is absolutely the case, and best practice is adopted in most instances. What we've seen, or what we have seen the last 12 months, is that schemes have or are better funded. They're in a better funding position than they obviously were 12 months ago. That should be quite clear to everyone. And there are target funding ranges, anywhere between 110 to 130%. And we've taken a look at the broad market and assessed what those funding ranges are, and we try to keep a track of where that information is publicly available, how those schemes are tracking to that target range. And as we mentioned earlier, it does come back to risk appetite. It does come back to the fact that these assets are long-term, and also what is the policy of the government of the day in terms of wanting to take money out of the scheme as a dividend, not wanting to contribute to the scheme, and the risk and return objectives that scheme sets for itself. And this is quite different again to a general insurer who, although invests for the long term, does have financial year objectives and a shorter tail of liabilities. So there are some significant differences, but also some similarities as well.
Because it is my understanding that when it comes to unregulated insurers, they can take one of two approaches. There is the accounting funding ratio measurement or the economic funding ratio measurement, which uses the expected long-term investment returns. Do you think there's a little bit of a moral hazard here where if you increase your level of growth assets such that your investment returns increase, that therefore lowers the level of your liabilities? Do you think there is a risk presented in there?
There is absolutely potential for that. And we've seen a move towards the more economic, the use of discounting those future returns. And that does improve the funding ratio and the balance sheet outlook for these schemes. The question really is, will that change once bond yields normalise? Or are we seeing a more permanent shift, a more permanent identification of the expected return of these asset classes? And the assumptions that either the actuary is building into assessing those liabilities or the consultant is assessing or the manager is using to assess the expected return of those portfolios, are they appropriate? Do they move around year on year? Are they market aware, or are they set in stone effectively for the 10 or 20 years ahead? So there is potential for moral hazard. There are also questions about how you approach it and whether you're being consistent in applying the economic or the accounting treatment.
So Joaquin, if I go back over to you, when it does come to regulations, the general insurance industry and the life insurance and private health insurance industries are probably one of the most tightly regulated in Australia. When it comes to the investment portfolio, there's obviously a limited number of things that you can do. Each different asset class will attract a different capital charge. Do you and the Suncorp investment team do any work around perhaps finding slight gaps in the standards, something that I guess you could call regulatory arbitrage in a sense, but all in the name of capital efficiency for a good return?
If you're saying whether we're trying to game APRA at their own game, I would say no. I think the standards are pretty straightforward, although some aspects of it could attract a few different interpretations, but we have always erred on the side of being conservative, and Suncorp's capital team as well. Our capital model has gone through a few iterations, has been, gone through internal audit, external audits, a number of auditors, and it's also been endorsed by APRA for a few times over the last 10 years or so since LAGIC has come in place. So we tend to be more conservative, and if there's a variation in interpretation, we would go for the more conservative option. So case in point, from a portfolio construction perspective, given that the Aussie dollar is a risk currency, when you have global equities exposure, it makes sense to have some sort of currency exposure in the book, some sort of unhedged ratio in your global equities portfolio. But that currency attracts very high capital under LAGIC, and so that's that trade-off that you need to consider. And that's one of the things that you may have to give up on.
That's a really good point you made, Joaquin, about currency. If I think about the government insurers and their tax status, typically they're zero taxpayers, so not tax exempt but zero taxpayers. So they have a preference for total return and CPI plus investing, regardless of whether that's in Australian equities or global equities. In fact, being a zero taxpayer puts those asset classes on a more equal footing. It's a different reason for why general insurers might invest in Australian or international shares, but it also has an impact on how you invest in equities generally. And we have seen a move towards more international equity portfolios on an unhedged basis, with the ability to move that hedging level around, but to try to capture some of that long-term global growth thematic, not just in the Australian market.
While we are on the topic of...
Sorry, Eli, I'm just so curious. Do they get franking credits?
No, they don't. No, they don't.
While we are on the topic of asset classes, I have a question from the audience. Probably direct this at you, Joking. What has been the take-up of absolute return liquid alternative strategies by insurance clients? And if the take-up has been low, why is that so? Is it because of the complexity or an inability to provide LAGIC reporting or something else?
Liquid alternative, when it came about, was very attractive, right? It provides the liquidity that short-term insurers need, and it promised the exposure or the returns offered by the alternative risk premium that normally hedge funds to deliver, and at much lower fees. Who wouldn't jump on that ride? But experience has shown that it hasn't delivered, and complexity is an issue. And when you can't explain performance or the drivers to performance, especially when it's negative, in a clear and concise manner, it's very hard to get that across the line. And of course, as we all know, recently, liquid alts hasn't delivered, and so that really didn't help the case either.
In terms of government insurers, Desmond, there has been some take-up of liquid alternatives investments. They're probably less likely to invest just because they typically don't have the governance budget or the resources to undertake significant research into to that asset class. Mind you, there are exceptions. So we know there are some schemes investing in those types of strategies. But also, as I mentioned earlier, you've got to bear in mind who the stakeholders are and who those investment teams are ultimately reporting to. It's the scheme's board and to Treasury. And there needs to be a layman's terms, easily explainable approach to how do you explain and identify why these strategies haven't performed, and be able to justify that as opposed to just investing in equities and bonds or real assets. So sometimes that's also a hurdle as well.
Yeah, I echo that definitely. Especially for a listed company, we have AGMs, and you get your regular mom and pop during an AGM will ask you, what is this that you have? What is this line of investments that you have that have not performed? And besides that, there is an expectation also from analysts, the sell-side analysts, when they recommend our stock, the Suncorp shares, they do need to know what are we doing with investment portfolio as well. So we must be able to articulate our strategy clearly and the purpose of investing.
I suppose staying on the theme of AGMs and governance, we have another question from the audience asking what the difference is in terms of how both groups think about ESG. Should mention that APRA came out recently requiring, I think, most general insurers and the rest of the industry to consider climate risk in the long term. Yuki, I might start with you. How's Suncorp been thinking about ESG?
We've been thinking about ESG for a while now, and and the way we have approached is not only from an investment board, it's really a corporate initiative that came from the top. And so we're doing things on both sides as well, on the underwriting as well as the investments. So there need to, there need to be some, congruence in approach. Here we may be divesting from investments in coal and fossil fuels, but then on the other hand, we're still underwriting business, insurance to coal mines. That doesn't make sense. So it's a long-term strategy, and Suncorp has made strong commitments to that. They have laid out a climate change plan in that was rolled out at the AGM, I think about 3 or 4 years ago. And ESG, we are progressing on that in all. I would say that in all our portfolios, that there is a list to be considered, even for our fixed income books.
And if I could also address that too, Desmond. So there's two parts of this for me. One is there an impact on the liability side for these schemes, and is also there an impact on the asset side? From a liabilities perspective, as opposed to a general insurer, climate change risks have little impact on, you could argue, the number of car accidents on the road, or the ability for drivers to drive safely and not take unnecessary risks, or the amount of claims that happen because of workplace injuries. I haven't yet found a link. I'm happy to be challenged if there is a link. So if it doesn't impact the liability side, then the question then comes down to whether there is an impetus on the asset side of the balance sheet. So typically we would expect that governments themselves would be imposing higher standards around ESG risks, as the private sector is also moving in that direction. And so directions from Parliament, Treasury, other government departments, or the boards, the schemes board itself, might direct the investment team to move to more sustainable or ESG friendly investments, perhaps avoid modern slavery where possible, for example. And then the other part of the asset side question is there a benefit? Is there additional returns that are being left on the table by not pivoting or moving to more ESG friendly strategies or ESG targeted strategies? And that's a question for consultants, question for asset managers, fund managers, and the schemes themselves.
Yeah, to add to that, there is a direct linkage for us to the liabilities given from climate change, given the impact on natural hazards. If you see there's been, high incidence of storms and hurricanes and stuff, that has a direct impact on our bottom line, bushfire, for example, and stuff like that. So, Suncorp's been doing a lot of work, especially up at Northern Queensland and around Queensland. We are a Queensland-based company, working very closely with the government. There's heaps of initiative. If you go on Suncorp's website, there are heaps that they do on this front. They're trying to build houses that are more sustainable, that can withstand different sort of climate change and climate impact as well.
Linkage is probably a good segue into our next topic, which is around the experience of COVID-19. Now, Eugene, you mentioned that when it comes to natural hazard events like bushfires, like hail, storms, even earthquakes, as we had in Victoria a few weeks ago, those will generally be associated with both economic damage and it could also have an impact on financial markets. Obviously, this wasn't quite the case with COVID, but during those large drawdowns that we saw in March last year, was it panic stations at Suncorp? Was it regular reporting to the board? Or was it very methodical, planned out based on your risk framework?
FY 2020 was very stressful, very stressful. Even before COVID, we had bushfires. We had, all sort of natural hazards in that first half of the financial year. So there was already a level of stress. And then you add on COVID, and everyone was just running around like a headless chicken. There were reportings and there were, questions being asked, every day. There was stress testing. But nothing like a good stress, market stress environment to really test your risk appetite, I would say. But fortunately for Suncorp, we did come out the other end quite well, and we still managed to pay a dividend, a final year dividend, despite that harrowing year of experience. And largely because our conservative approach to investing, but also being more tactical and active. And, that really saved the bacon, I would say, at the end of the day.
I do have a chart up here right now that shows the change in asset allocation over the pre-COVID period, which is defined as 31 December 2019 to FY21. We don't want to name names, but they are up on the screen. So would you say that the reason why Suncorp's portfolio didn't really move was, again, based on that very conservative approach?
Partly, yes. I would say part of that, but also the investment team and also the senior management has reacted quite quickly to that, putting on, how should I say this without saying it, but putting on hedges at the right places at the right time was very opportunistic. And as we all know, market timing is hard, and element of luck comes with it as well. So we were fortunate in that sense. But having said that, we already have the infrastructure in place for those kind of scenarios. And I think it's a remiss for an investment professional working in a corporate setting to not have regard for the capital management plans, as a broader business. Because under times of stress, capital is at stress. And the first place they will call on to raise capital is to de-risk assets, because that's the easiest thing that they can do. And so you will be forced to sell off your equities, which are probably the only most liquid stuff in your portfolio during that environment, at a huge haircut, at a huge discount, you know. And depending on your capital strength, the business capital strength or cash flows or whatever that is, and it might be a long time before you can get back into equities. And we saw that sharp recovery from COVID, and many have missed out, having forced to sell risky assets just to meet the capital needs. So I think when we're setting our strategy during good times, we have to really be, you know, cognizant of this risk. But on balance, you know, you really can't be too conservative, because you can't construct a portfolio for a 1 in 200 year event that, you know, you'll be in cash, right? You won't invest anything, and you'll give out on long-term returns, and that will have its other complication as well. So it's really balancing that consideration for risk management and your long-term returns, and then also having an overlay of being active in your portfolio in that sense, in terms of hedging and being smart about it.
So if we go back to that linkage between liabilities and investments, I know that Suncorp has a book in workers' compensation too, but perhaps this will be a question for you, Eli. We saw that with all the lockdowns that we've encountered, there's been a material increase in the level of mental health claims, which has resulted in a very large strengthening of workers' compensation claims that affect both general insurers and life insurers. If we were to be in an environment where we didn't have the level of government support and the level of the market bouncing back, do you think that this is a risk that insurers need to take, especially historically, when you wouldn't expect this kind of event risk from the likes affecting CTP or workers' compensation?
Yeah, it's a really good question, Desmond. And look, the reality is it's really difficult. So if I think about the potential for high mental health care claims for workers' comp schemes as a result of injuries in the workplace, that potentially is too early to tell what the likely long-term impact is, and whether that's a permanent impact because of COVID and the shift we've seen in the last 12 months. And as Joaquin pointed out earlier, she's absolutely right. I mean, any crisis is a good opportunity to test your organization out, but every crisis is different. And this is very different to the global financial crisis and every one before that. So I would suspect, and I know where this is the case, some schemes, particularly workers' comp schemes, are looking at quite deeply the data coming through on mental health care claims and the likely impact on the assumptions for the liability profile going forward. And what does that mean for central estimates and the risk margins, i.e. the uncertainty of those potential claims coming through in the future? The main question, or the key question I then ask myself is, what does that mean for investment strategy? What is the so what if there is a rise in claims? Well, you'd have to say that the sponsor of the schemes would be required, where appropriate, to make sure those schemes are well funded. So in a time where government budgets are not as healthy as they were, this would put more pressure on them. Or is there more pressure on investment teams to produce a better investment result? And that's a difficult one. There's only so much you can invest in equities without pushing the boundaries on your risk appetite. And of course, there's no guarantee that taking on higher levels of growth results in higher return either.
No, I agree, Eli. I mean, there's always a tension, you know, there's always a tension between underwriting and investments. And they have cycles as well, right? You know, insurance cycle goes through soft and hard periods, and then, you know, and investments, obviously, as we all know, have its own volatility along the way. And you know, as in good case studies in Europe, right? Negative yields. There's not much you can expect from investment portfolio, and at the same time, some of the underwriting business have been suffering as well. So, yeah, how do you make on returns and your promise to shareholders?
So we've had a look at the past, and what if we turn to the future? I might open this with one of the questions from the audience, and it is, with global rates relatively low now and forward-looking, are insurers looking to take great advantage of the illiquidity premium available in unlisted strategies such as private debt, real assets, which includes property and infra?
I'm happy to jump in there, Desmond, and thanks for your question. The answer is yes. And particularly for the schemes that we've been referring to, CTP and workers' comp schemes, they are typically cash flow positive. So liquidity is less of an issue. Immediate liquidity is less of an issue, even in stressed environments. And therefore, there is appetite for investing in illiquid markets, whether it be credit, infrastructure, or property. And if you do make the case for illiquids, then the question is, what type of unlisted assets are you trying to get exposure to? Which type of assets on a look-through basis give you the best inflation protection and the overall best risk-adjusted return? Are they defensive core utilities? Are they airports that have GDP linkages? Are they healthcare assets? Are they build to rent or needs-based property? And does yield matter at all? We don't have, that is, Frontier doesn't have an absolute preference for yield over capital growth for government insurers, but you could argue for general insurers, it could be a different story. And then we've also seen the adoption of greater and deeper alternative debt portfolios or illiquid private debt portfolios for that diversification and also for additional yield over and above what a typical fixed income portfolio might return. So I would think that given their long-term nature, their CPI plus return objective, and the fact that CTP schemes and workers' comp schemes have very long duration liabilities, that private markets, particularly infrastructure and property, are ideal assets for these types of investors.
Okay, so it's my understanding that Suncorp has a decent chunk of its investment portfolio in inflation-linked bonds, and that there is a decent portfolio in workers' compensation and CTP schemes. So my question to you is, has Suncorp been thinking about these illiquid assets? In the case of property and infrastructure, Eli mentioned that there is sort of inflation protection embedded within those, but also what about alternative debt?
Oh, for sure. I mean, the challenges that we face is probably not unique. Low yields, where do you look for returns? I guess the problem is pricing illiquidity premium and how comfortable you are with that. And also along that, I mean, especially for alternative debt or private debt, how far along in the spectrum are you willing to play, or can you play? You know, you can go all the way down to distress, and get some reasonable returns with that, but at a much higher risk, not only in capital costs, but also, you have your money tied up for a number of years, and also higher default risk and stuff like that. So it again, it's a risk appetite question again on that. Unlisted assets, in terms of infrastructure and property and those sort of real assets for inflation hedging, it's a no-brainer, right? I mean, the problem is getting invested. There's a lot of money channeling into the private space now, and it's not only from insurers, right? It's from across the board. All sort of institutional investors are looking for returns and yields, and getting invested is probably the key priority. And again, and in that space again, you would want to customize your portfolio as well, like Eli said, maybe for his clients and the LDI clients do not have a preference for yield and growth, but then you could have a tilt towards yield, perhaps, if you do want to have a lighter capital charge or something like that, or in a more stable income return stream, a more stable income profile. So there's things you can do, and definitely stuff that we've been looking at as well.
Great. So we have another question from the audience. Given the need to protect capital in a market drawdown, and this is probably relevant to unlisted assets that do sort of have that volatility dampening effect, where many insurers were being forced sellers of equities during COVID, to what extent should defined downside protection strategies be utilized? So this is probably in relation to options as well as various other derivatives.
Is that for me?
I think that's for you, Joaquin.
That's for me, options and derivatives. Love it. Love it. Well, personally, I think, having a tail risk tail risk hedging strategy in place, and whether you implement it or not, having that infrastructure set in place. Because, working in a corporate environment, coming from a consulting background, I realize there's a lot of operational aspects, that we don't see in the consulting side. On implementation, it takes sometimes 6 months just to set up a global equity mandate. I'm like, what's going on? So having that sort of infrastructure set up, which means you need to think at the outset when you're setting a strategy, what sort of tools you want in your toolkit, definitely will play a role. And so I think having those set up, and then it's probably the first priority. And then the second step is really to then convince your stakeholders, senior management, on what you need to do. Because, with protection, there's costs. For an insurer, this shouldn't be a foreign concept. They're used to reinsurance. You pay a premium to reduce your exposure to certain insurance risks. So you pay, but it's harder in an investment sense, because they think that, I think some people feel that it's always that bias for investors mindset. When market's running, you think we're doing well, we're fine, we're all right, we don't need to protect. And then when it comes to the downturn and trying to put a hedge on, my experience was that people still hesitate, because they're worried that we might miss out the bounds, or how much would it cost us, and we're already at the bottom now, don't worry about it, and things like that. It's just all sort of emotions come into play. So I think having the infrastructure set up, and then a broad strategy and a framework to go along with that really helps when it comes to the crunch, and when you really need to deliver on it.
Yeah, and from my perspective, best laid plans aren't always followed through.
Yes.
And it's much easier planned or said than done when the rubber hits the road during a crisis. But my observations have been that in the government space, there's a wide range, from some schemes who are willing to take positions in overlay strategies and derivative strategies, to those who want to avoid it. And that's largely down to, from what I can tell, the level of governance oversight and complexity that those organisations are willing to take on and absorb. And essentially what we've seen as well, that for those schemes that use the state-based fund manager, they're more likely to adopt greater levels of complexity, because there is an outsourced fund manager who has complete oversight and responsibility for delivering an investment result. And so that, I think, plays into the hands of, yes, we are willing to take on more derivatives or complexity for the sake of the overall outcome, because we have the people and we have the resources to manage that complexity. And I've seen also the other end of the spectrum, where some schemes will only have derivative exposure through the strategies managed by fund managers. So it's a completely outsourced approach, but they are reported back to the investment team and the board. They monitor those positions. And of course, they must understand the likely pros and cons or outcomes from those derivative positions in any type of environment. And so from a consultant's perspective, we would say that your SAA is the main game. Sometimes you'll have dynamic asset allocation processes inbuilt as part of that, where you can shift the portfolio in extreme circumstances. But you can also use downside strategies if you like, and if you have the governance, budget and structure to manage those crisis scenarios.
So we're sitting at about 10 minutes before the end of the session. Perhaps I'll ask one final question, unless there are more from the audience, just around the current inflation outlook and where low interest rates currently are. So if we take inflation expectation of approximately 2.5% and current yields, we know that there is quite a steep negative real yield right now. Now, Joaquin, for Suncorp's portfolios, does this change the way that they match their portfolios, as in $1 fixed income per dollar of liabilities, given that there is very limited upside for the assets if interest rates fall further? Probably the greater risk, isn't it, that interest rates are going to increase, which will result in negative returns. How's Suncorp thinking about that?
We've been talking about inflation for many years now, right? Given the amount of LVs held, I mean, there's no secret. I mean, everyone out there knows how much LVs we hold. It's in our annual report anyway. Look, inflation we have to approach it, first of all, strategically. You know, there is inflation risk in the liabilities that we need to hedge, but you know, with claims inflation, it's so hard. You know, the actual claims inflation, you already know after the fact when it's realized. And you know, in those earlier years when break-evens was going down, inflation was going down, obviously our ILB books portfolio suffered. But you know, actuaries, luckily we have actuaries. You know, actuaries are our friend. They're so conservative. They set such a conservative assumptions, and then it comes throughout all the reserve releases. But obviously there's a timing issue, right? Because investment portfolios mark to market, but then the actuaries take a while to oh yeah, inflation is lower now, so we can actually release reserves. So we do get that sort of offsetting effect for that. But for now, I think inflation now, maybe not so much in Australia yet, but globally and in the US, is really quite focused. And the word stagflation kind of scares me, but also I'm quite comforted by the amount of ILBs that we have. I mean, that's scenarios I think ILBs would do very well. But you know, there is a long-term cost to holding ILBs because it is a form of protection, right? So, and we have won that cost over the years. So first of all, think about it strategically, where you're trying to hedge the basis risk around that. What's your claims inflation doing and stuff like that. And secondly, you look to the market, medium-term outlook, have a view, be comfortable with where you are.
And from my perspective, that is the ultimate question, Desmond, is what's your outlook for inflation and how hedging it? It's both an opportunity and it's a risk, it's a threat. From my perspective for government insurers, it's very much the fact that the SAA, your total investment pool, is a hedge against all your inflation exposures. It's a hedge against CPI and superimposed inflation and all the other risks that come with the potential for higher realized inflation versus expected inflation. And so if you can understand how each part of the portfolio responds in different inflation environments, again, there's no exact science behind this. There's many ways to do this, and there's no black and white answer either. But if you can navigate your portfolio through the different economic and inflation scenarios and deal with the worst potential outcomes at the SA level, then I think you're most of the way there to building a portfolio that's both sustainable, will perform over the long term. Because if that inflation spike catches you unaware and you're not prepared for it, then it's very, very difficult to try to get ahead of that. And the last thing, as I mentioned earlier, that investment teams and schemes want to do is ask the government for more money at potentially precisely the wrong time. And at the moment, we're seeing higher inflation through commodity prices. We're seeing a bit more volatility. Although Frontier has a view that inflation will be lower for some time, the risks on the horizon are rising. And you'd have to say that at some stage, there is going to be some level of inflation in the economy more broadly.
In terms of your investment portfolio, has there been a change in that? Obviously, if we get large inflation, but then you're still holding a 3-year bond, you'll be getting 0.1%, which will be acting against, say, 2% inflation. Has Suncorp changed their approach? Have they adopted more of, say, a barbell approach where they're buying long duration bonds and then offsetting that with more short duration floating rate notes? Has there been a particular focus on that 3-year tenor?
It has been thought about, but implementation consideration comes into play because of capital as well. Practically, it sounds very appealing, right? You possibly could do that, but practically there are challenges to implement it.